Understanding the next question. An Indian company is planning to set up a subsidiary in US. So India is going to take up a project in United States of America. The initial project cost is estimated to be $40 million. Working capital requirement is $4 million. The finance manager of the company estimates the data as follows. Variable cost of the production per unit is $2.5. Per annum fixed cost is $3 million. Selling price is $10. Production capacity is 5 million units. Estimated life of the plant is 4 years. Method of depreciation SLM. Salvage value at the end of the 4 year of the useful life is 0. The subsidiary company of Indian company is subject to 40% of the tax rate in the United States of America. Required rate of return of such project type is 12%. Spot exchange rate is 48 rupees per dollar. Rupee is expected to depreciate by 3% per annum for the next 4 years. The subsidiary company shall be allowed to repatriate 70% of the cash flow every year along with the accumulated arrears of the blocked funds at the end of the 4 years. The withholding tax is 10%. The block funds will be reinvested in United States of America money market by the subsidiary, earning 4% free of taxes per year. Determine the feasibility of having subsidiary company in US assuming no tax liability in India on earning received by the parent company from the US subsidiary. That is the question. So friends, over here we'll go with the working like this. Importantly, over here in this question, ready-made cash flows are not provided to us. So first of all, we are required to prepare the working for the purpose of determining the cash flows in the foreign currency term, which is usually provided to us in the examples. So basically over here the question is requiring us to prepare the cash flows with respect to the foreign project which we are going to undertake, and then we have to apply the routine process for the purpose of doing answer. So let us have working one by one with the working notes. Let us start with the answer. Step number 1, investment. As far as the investment is concerned, in that it is $40 million, that is the project cost or capital investment, and $4 million is the working capital. Capital investment is $40 million. Working capital is $4 million. So total investment is $44 million. Step number 2, depreciation. It is cost divided by number of years. What is the cost? It is $40 million divided by 4 years. So it is $10 million. Step number 3, terminal cash flow. In that we will have the recovery of working capital. $4 million. There is no capital gain or loss on sale of the asset. Further, there is no sale value of the asset. So there is only working capital recovery is cash inflow. Step number 4, a recurring cash flow. In that Working note number 1, calculation of cash flow. Selling price is 10, variable cost is 2.5, production capacity is provided to us, but actually how much we are going to use is not given. So we assume that say whatever the production capacity that we have itself is the amount sorry itself is the capacity that we are going to use, and accordingly we'll make the calculation of the sales. Fixed cost is given and depreciation is given. So working note number 1 is cash flow for the first year. Sales, it is 10 and this is 5 million. It is 15. Variable cost 5 million into 2.5. 12.5. Cash fixed cost is 3. Depreciation is 10. Profit before taxes 24.5. Income tax rate is 40 percentage. $14.7. Depreciation is 10. CFAT is 24.7. That is the way the cash flow is calculated. Then working note number 2, calculation of amount of repatriation, comma, from year 1 to year 3. As far as the first 3 years is concerned, in that CFAT, it is $24.7 million less withholding tax, it is at the rate of 10 percentage, $2.47 million. I'm sorry, first of all, the question is providing that say only 70% can be repatriated and withholding tax is 10 percentage. I'm sorry, first of all, from 24.7, we will have that less amount to be reinvested in US money market. Because you can withdraw only 70 percentage. So 24.7 into 30 percentage. So 7.41 will be reinvested. Remaining is amount of cash flow to be repatriated before withholding tax. So 24.7 into 30%, 7.41, that is deducted, so it is $17.29 million. Then you have to pay less payment of withholding tax. It is at the rate of 10 percentage, 1.729. So amount of repatriation 15.561. This is the amount that will be repatriated from end of year 1 to end of year 3. Next, working note number 3, calculation of amount of repatriation at the end of year 4. Now friends, whatever the amount which is reinvested over there, for that the information is provided to us that it will be able to fetch a return at the rate of 4% free of tax. So we understand like this: future value of reinvestment of cash accrual. So it is 7.41 into FVIFA at the rate of 4% for 4 years. That is how we will compute the future value less payment of withholding tax. It is at the rate of 10 percentage. Add recurring cash flow. That is 15.561. This is the cash flow of the 4th year end. Now FVIFA at the rate of 4% for 4 years. The formula is very simple: 1.04 raised to 4 minus 1 divided by 0.04. 234 minus 1 divided by 0.04. So 4.246464. Into 7.41. That comes to 31.47. 31.466. Let us keep it like that. So 31.466 into 10 percentage. 3.147. So 31.466 minus 3.147 plus 15.561 is 43.88. That is the cash accrual at the end of the 4th year. That is what we understand. We can do this answer with an alternative method. I am explaining that to you. If at all you want to do with that method, the 4th year cash flow, you can do like that also. We can say this 24.7. So CF18 of year 4, it is 24.7. We understand it's a basically this 30% will not be calculated because in the fourth year there is nothing which is reinvested. Okay. Then add future value of reinvestment of internal cash accrual. It is 7.41. That is the amount which we have reinvested every year into FEIFA at the rate of 4% for 3 years into 1.04. First of all, it is compounded to third year end, and then it is once again compounded for one more year. So 1.0423 minus 1 divided by 0.04. So what will happen over here? 7.41 into 3.1216 into 1.04 into 7.41 into 1.04. 24.056. Okay. This is the fourth year. Total cash flow to be repatriated. So 24.7 plus 24.056. It is 48.756 less withholding tax at the rate of 10%. 4.876. 48.756 minus 4.876. That comes to 43.88. This is the cash flow of year 4. This is what we understand. And you can see it is exactly matching with this one. Next, step number 5, calculation of NPV. In that working note number 1, calculation of the cash flow, first of all in dollar term. So it is year 0, year 1, year 2, year 3, year 4. Year 0 it is 44 million outflow. That is over here. Investment 44. Then recurring cash flow is 15.561. In the last year, what will happen? 43.88 plus working capital recovery 4, 47.88. This is the cash flow that we have. Okay. Now, working note number 2. Calculation of NPV. So what will happen? Year 0, year 1, year 2, year 3, year 4. This is the cash flow in dollar currency. Then exchange rate. Rupees per dollar. Year 0 exchange rate is 48. Which is provided over here to us. 48. Then rupee will depreciate at the rate of 3%. So what will happen? It is 48 into 1.03. That is the exchange rate at the end of the first year. Second year it is 48 into 1.03 raised to 2. That is the exchange rate for the second year. Similarly for third year. Similarly for fourth year. That is how we will have the exchange rate. Then we'll have the cash flow in a rupees term. Later on, we will be having discounting of the cash flows. The required rate of return is provided to us as 12%. So discounting at 12%, cash flows into present value factor. Product of the both of them will make the summation of the same, and that is the way NPV will be calculated. So third year and fourth year, it is 48 into 1.03 raised to 3, 1.03 raised to 4. So it is 44 million, 15.56 million, 561, 15.561, 15.561, and last year it is 47.88. Let us see cash flows in rupees term. 44 into 48, so 2112. 48 into 1.03, 49.44 into 15.561, so 769.34. Next year it is 50.92, 52.45, 54.02. $792.37, 816.17, $2586.48. Then discounting at the rate of 12%. First year factor is 8929, second year 7972, third year 7118, last year 6355. Year 0 factor is 1, 2112 into 1, 769.34 into 0.8929, 686.94, 792.37 into 0.7972, so 631.68, 816.17 into 0.7118, so 580.95. 2586.48 into 0.6355, 1643.71, 686.44 plus 94 plus 631.68 plus 580.95 plus 1643.71 minus 2112, so 1431.28. This is the answer in the rupees term, and we can say that say as NPV is positive, the project should be accepted. This is the way we are required to write answer. So finally a summary. Step number 1, investment in foreign currency, $44 million, capital investment and working capital. Step number 2, depreciation, SLM method, simple, it is $10 million per annum. Terminal cash flow, $4 million, working capital recovery. In this question, in my opinion, recurring cash flow is the important working note. First of all, for year 1, we have made the computation of the CF18. That's very simple. And we are assuming that say we are going to work at full capacity. Amount of the repatriation during the first 3 years. Whatever is the CF18, of that 70% is supposed to be repatriated. And before repatriation, 10% is the withholding tax. Fourth year, repatriation is further important. We can say that's the future value of the internal cash accrual at the end of the fourth year. From that, say we are required to pay withholding tax, and this 1, 2, 3 recurring cash flow as it is. Or otherwise, what you can do, fourth year cash flow, from that you pay the, further you add future value of the internal cash accrual that you have invested, 7.41 for 3 years. So what happens, I'd say, product of this two comes to at the end of the third year into 1.04, that is compounded to the fourth year end. From this amount you pay withholding tax, and this is the cash flow for the fourth year. Then simple NPV calculation. We understand that so the rupee currency is depreciating at the rate of 3% per annum, means per dollar, say more amount of the rupees will be available. It is at the rate of 3%. Dollar is converted to rupee and then discounting at the rate of 12%. With that, NPV is calculated. We have to accept that is we should accept the project because NPV is positive. That is the way we can write one line answer.